Welcome to the Deep Dive. Today we're jumping straight into the Q1 FY26 results for GMR Airports Ltd. That's GM Airport. Now, this quarter is, well, it's a really interesting one. We saw quite a bit of positive operational news. Management sounded very optimistic, but the market, the reaction was, let's say, pretty subdued. So our mission today is to really unpack that, understand the story behind the numbers, and try to figure out why investors seem to be, holding back a bit.
Yeah, it really has that classic show me feel, doesn't it? Where the narrative is strong, but the market wants concrete proof before jumping in.
Exactly. So let's kick off with a quick look at the numbers. GAAP EPS was actually a small loss, about 0.14, which surprisingly beat the street estimate slightly. But the big one for me was total income, the revenue. Came in strong at 3,321 crore. That's a robust 32% jump year over year. And it actually beat consensus by about 2%.
It's quite solid growth on the top line.
Definitely. And EBITDA followed suit, 1,280 crore, up 26%, with a pretty healthy margin of 38.5%. Also, the loss from continuing operations narrowed significantly, about 60% better than last year. And traffic, growing too. Over 30 million passengers, up 4%. Delhi handled 19.1 million, and Hyderabad, well, they hit a record 8.1 million.
Right, but here's the interesting part you mentioned. Despite those numbers, the beats, the growth, the share price actually dipped a little on the day, closed down 0.42%. And even though trading volume was higher, that kind of muted, almost negative reaction, it definitely signals some investor caution. They're looking past the headlines.
Okay, let's unpack that then. What's driving the actual earnings potential here? The main lever everyone pointed to was the Delhi Tariff reset. Control Period 4, or CP4. This kicked in around mid-April, so Q1 only got, about 10 weeks of the benefit? But even just that partial impact was pretty dramatic. Aero revenues at Delhi Airport, they soared 127% year over year. That's huge. And management made it clear they expect the full impact from Q2 onwards. How does that flow through the bottom line?
Oh, it's expected to be massive. Management sounded very confident about this. They're basically saying Delhi Airport, which is, let's be honest, their most important asset, should turn profitable in Q2, specifically because of these new tariffs. I mean, they already reported Delhi's highest quarterly EBITDA in 4 years, just with the partial impact. So this isn't just a small tweak. It's a fundamental shift for their biggest revenue generator. It should bring much more stability.
And it wasn't just tariffs, was it? The CEO talked about a much bigger picture, a strategic pivot. He said, our platform is transitioning from pure concessions to an integrated aero-commercial ecosystem. That sounds like more than just running airports. It's about duty-free cargo and, interestingly, developing their land bank. That's quite a shift.
It's a really significant shift in strategy. Yeah, it's moving beyond just managing the regulated airport infrastructure, the concessions, towards owning and integrating these other often higher margin businesses that happen around the airport. Think duty-free shops, cargo handling, hotels, logistics parks.
So creating a whole ecosystem.
Exactly. They call it the platform play, and it's really picking up speed. Look, GMR Airports, GAL, they took over Delhi cargo operations back in May, and then Delhi Duty-Free just at the end of July. Hyderabad Duty-Free is apparently next, slated for Q2. The key here is vertical integration. They get 100% ownership, unlike previous joint ventures, capturing all the profit. And, importantly, these non-aero businesses are generally less exposed to regulatory tariff reviews, so it potentially smooths out earnings volatility.
Right. Makes sense. Less reliance on the regulated side.
Precisely. And then you mentioned the land bank development. This is potentially a very big deal long term. They've got actual projects moving now, agreements with Hilton for a Waldorf and a Hilton hotel at Delhi, and with IHCL for a Taj Vivanta at Hyderabad. The idea is to turn land they already own that's maybe underutilized into assets generating ongoing rental income. They're really trying to position themselves as sort of an airport city developer, building a whole commercial hub around the airport core.
That paints a very different picture for the future valuation, potentially.
It could, absolutely. It's a long-term play, but it changes the narrative. And you also see innovation like Hyderabad's record traffic and launching India's first cargo loyalty program, Keel-IM, shows they're thinking about data and customer stickiness too.
Okay, that strategy sounds compelling. But let's circle back to the present and the balance sheet, because Q1 still showed a reported loss. Management flagged a 1.4 billion Forex loss on those foreign currency convertible bonds, the FCCBs. That definitely hit the profit after tax number. Seems like a negative.
It looks like one on the surface, yes. But management was quick to point out this is largely notional. It's an accounting thing, a mark-to-market adjustment because of Euro INR fluctuations. It's not actual cash going out the door. In fact, they stress these FCCBs are deep in the money, meaning the holders are very likely to convert them into equity shares eventually. When that happens, this accounting loss actually reverses and becomes a one-time profit. So it's sort of a temporary accounting headache, not a cash drain.
Okay, that context helps. But what about the actual debt load?
Right. So excluding those FCCBs expected to convert, their consolidated net debt is around $325 billion. It did go up by about $14 billion this quarter. Part of that was due to acquiring the ESR GMR logistics part, making it fully owned now.
But here's where it gets, well, really interesting, or maybe concerning. The interest expense. It ate up 72% of their EBITDA this quarter. That's a lot. How are they tackling that?
Yeah, that's a huge number, and it's definitely something investors are watching very closely. It's a major drag on profitability right now. The good news, though, is they have a clear plan. They recently got credit rating upgrades, CRISIL A plus stable, carry A. That's important because it opens the door to cheaper financing. Management specifically said they're targeting about $60 billion in non-convertible debenture or NCD issuance. The goal is to use that cheaper debt to pay off older, higher-cost loans. Their current blended interest rate is around 14%, which is high. They're aiming for a significant reduction in interest costs. And they expect this refinancing to happen soon, maybe by the second or third week of August.
So that could provide some immediate relief to the bottom line if it goes through.
Absolutely. Lower interest payments flow directly to improving profitability and cash flow. That's a tangible catalyst the market is likely waiting for. They also guided for about 4,000 crore in capex for the full year, FY26. That's for things like runway upgrades and their newer airport projects in Bhogapuram and Crete.
Okay, switching back to operations then. The airports themselves seem to be performing well. We mentioned the overall traffic up 4%. Delhi grew even with some geopolitical headwinds affecting routes. Hyderabad set records for traffic and EBITDA. And even the newer Goa airport, Mope, managed positive EBITDA despite having revenue sharing. What about the non-aero side specifically?
That's showing good momentum, too, supporting the diversification strategy. Combined non-aero revenues across Delhi, Hyderabad, and Goa were up 15% year over year. We saw improvements in spend per passenger in duty-free. Delhi's figure jumped quite a bit, and Hyderabad saw a decent increase, too. Hyderabad Airport also declared another dividend, bringing the total for FY25 so far to €10 per share. GMR's share of that is about $2.8 billion. And that ESR GMR Logistics Park acquisition, they expect that to be highly value accretive, targeting returns in the high teens, which is quite strong. Plus, their MRO, the maintenance, repair, and overhaul business in Hyderabad, signed a new 3-year deal with Akasa Air for Boeing 737 maintenance. That's a good sign, given airline fleet expansions.
Now, there was also a significant legal development, the TDSAT ruling. That's the Telecom Dispute Settlement and Appellate Tribunal. They essentially threw out a calculation of the hypothetical regulatory asset base, or HRA, for Delhi Airport. Sounds technical, but potentially impactful.
Potentially very impactful, yes. It sounds like jargon. But HRAB is basically the asset value used to calculate regulated airport charges. The tribunal has ordered AURA, the regulator, to recalculate this HRA for Delhi, and they have 12 weeks from July 1st to do it. Critically, the recalculation has to include all revenues and costs, aero and non-aero, going way back to FY 2008 or 9. This could mean Delhi Airport might be able to claim significant underrecoveries from the very first control period, potentially unlocking substantial value. Management sounds confident, but there's a catch. The timing is uncertain. AURA could appeal the ruling. So it's a definite positive catalyst, but maybe not an immediate cash inflow.
Right, one to watch. Okay, let's zoom out for a second. The bigger picture for Indian aviation seems strong, right? Demand is resilient, travel's accelerating. Management made a good point. The real cost of flying in India has dropped something like 40% in the last decade, makes it much more accessible.
Absolutely. That affordability factor is a huge long-term driver. Demand isn't really the issue for the sector right now. The main challenge, ironically, is on the supply side, getting enough planes due to production delays at Boeing and Airbus. Though there are some positive signs. Airbus mentioned supply chains might be stabilizing, and they plan to ramp up A320 production significantly by 2027. For airports like GMR, this continued demand translates into sustained traffic growth and the need for more infrastructure, which underpins their whole expansion strategy. Management themselves are guiding for mid-teens revenue growth, EBITDA over 5,200 crore for FY26, and importantly, hitting cash break even in the second half of the year as those non-aero businesses really kick in.
So we've got strong operations, a clear strategic shift, potential regulatory wins, a positive macro backdrop, and optimistic guidance. Which brings us back to the start. Why the flat market reaction? Management called Q1 an inflection quarter, but investors didn't seem to buy it immediately. What gives?
Well, it really boils down to that show me sentiment we talked about. The buy side, the big institutional investors, they seem to be saying, okay, the story sounds good, but we need to see the proof. Specifically, they're likely waiting for Q2 results to see a few key things materialize. One, the full impact of that Delhi CP4 tariff hitting the bottom line. Two, tangible evidence of the profit contribution from those newly integrated non-aero businesses, the duty-free, the cargo, the initial land bank revenues. And three, progress on that debt refinancing and reducing the interest burden. Until they see positive free cash flow consistently, there's likely to be some caution.
So even with positive analyst ratings like Jeffrey saying buy and Axis Direct add, the market's taking a more cautious stance for now.
Exactly. The narrative is there, but the market wants to see the execution translate into hard numbers, especially improved cash flow and a healthier balance sheet. But, the catalyst pipeline is quite full. Q2 results are coming up, which should show that full consolidation. There are traffic-linked tariff increases, milestone payments for the new airport projects. Then there's the HRAB recalculation clarity expected around early October, and maybe even potential stake increases by their partner ADP. If these catalysts hit positively over the next few months, that could be what finally unlocks the share price and validates management's multi-year transformation story.
Okay, that sets the stage perfectly for our This Is Not Financial Advice segment. Let's hear an outrageous but plausible trade idea for GM Airport.
All right, keeping the huge disclaimer in mind, this is purely speculative. But given the current setup, a plausible, though maybe needing some patience, trade idea could be to consider a long position, maybe through long-dated, out-of-the-money call options, or just buying the stock with a clear thesis. The rationale: the market's current skepticism. It feels like it's pricing in the wait-and-see more than the potential upside. That creates a potential disconnect. If, and it's an if, Q2 delivers strongly on the tariff benefits and shows real traction from the non-aero integration, and they execute that big debt refinancing in August, well, the market might be forced to reevaluate. You could see a re-rating. The HRAB ruling adds a kind of free option value on top, which doesn't seem fully priced in due to the timing uncertainty. So the trade is essentially a bet on management executing their plan over the next few quarters, transforming the perception from just a concession operator to this integrated airport ecosystem they talk about. Patience would definitely be key here.
Interesting. So to wrap up, GMR Airports put up strong operational numbers in Q1. They're clearly pushing forward with a major strategic shift towards an integrated platform model. And there are definitely significant catalysts, regulatory, operational, financial, lined up on the horizon.
And maybe a final thought to leave you with. Look beyond just the quarterly P&L. How much untapped value is really sitting in those large land banks GMR owns around its airports? And how quickly could that shift from just running terminals to developing these airport cities fundamentally change how the market values this company? Something to think about.
Absolutely. And remember, everyone, this discussion was purely for informational purposes. It is definitely not financial advice. We strongly encourage you to do your own research, look at the company's materials, and form your own conclusions. We'd love to hear what you think, though. Let us know if anything from this deep dive stood out or sparked any questions for you.